Look, right now, absolutely everyone is obsessing over GPUs, but there is a massive, hidden growth story unfolding right under our noses: the explosive return of CPU demand driven by AI inference. By the end of this explainer, you're going to have a serious edge on Intel's true roadmap. I'm literally saving you 2 hours of boring earnings call jargon. We're going to completely decode their first quarter earnings, and honestly, the signals we found are going to fundamentally change how you look at the AI hardware market. Let's get right into it.
So the first thing you need to know is that Intel is officially done playing defense. For the past few years, they've been stuck in what management literally called a survival phase. But based on this latest call, they are fully shifting gears into an aggressive expansion phase. And the numbers totally back this up. First quarter revenue hit $13.6 billion. That crushed Wall Street's midpoint estimates by a massive $1.4 billion. And by the way, that makes 6 consecutive quarters of beating expectations. This is a monumental turning point, folks.
Here is our blueprint for today's explainer. We're unpacking Intel's AI comeback strategy, the massive GPU to CPU shift, the truth behind the 18A margin squeeze, their long-term foundry potential, and exactly how they plan to beat AMD and ARM.
Let's kick things off with Chapter 1, Intel's AI comeback strategy.
Now, they aren't just launching new products, they are completely rewiring their core revenue structure. The magic number here is 60%. AI-related businesses now make up a staggering 60% of Intel's total revenue, and it's growing at 40% year over year. For a legacy tech giant, pulling off a pivot like this proves AI isn't just a corporate buzzword to keep Wall Street happy, it is their primary growth engine. I mean, their data center division alone raked in $5.1 billion, up 22%, and they're seeing demand literally outstripping supply across almost all product lines.
Moving right along to our second chapter, and honestly, this is the most critical insight from the entire earnings call: the GPU to CPU shift. This right here is the ultimate aha moment for your portfolio. Look, in the early days of the AI boom, everything was about model training. That requires raw brute force matrix math, which is absolutely GPU territory. Back then, data centers were running a CPU to GPU ratio of about 1 to 8. But guess what? The industry is shifting. We're moving into the inference phase. Think AI agents, edge computing, and real-world applications. In this phase, that ratio is dropping to 1 to 4. Management even pointed out that as we enter the era of complex multi-agent AI, we could eventually see a 1-to-1 ratio. This means CPUs are seeing a massive, structural wave of returning demand.
To really grasp why this matters for you as an investor, you've got to understand that CPUs are becoming the orchestration layer of AI. Think about it. When you ask an AI a really complex question, it might need to query a database, run some code, and generate an image all at once. A GPU cannot manage that entire workflow on its own. It desperately needs a CPU acting as the central brain, the control plane, to coordinate all those diverse tasks. So, Intel's Xeon processors, they aren't just getting a short-term cyclical bump. They are locking in as a long-term structural growth engine for the AI era.
Okay, quick pause. If you want to continuously get the latest US stock news and uncover hidden investment signals just like this one, make sure to hit that subscribe button right now. I update the channel with fresh, actionable stock market insights every single week, turning complex earnings jargon into actual investment knowledge. All right, let's keep going.
Let's get into Chapter 3 for a bit of a reality check: the 18A margin squeeze. So if you only look at the headline numbers, you might actually get the wrong idea here. Intel's first quarter gross margin came in at a super healthy 41%, which beat expectations. But their projection for the second quarter dips down to 39%. Now, Wall Street's algorithms and short-term traders might get completely spooked by that drop if they don't look under the hood. But we are going to look under the hood.
That margin squeeze? It's simply the hidden cost of ramping up mass production for their highly anticipated 18A node, specifically for the Panther Lake chips. Whenever you start manufacturing a cutting-edge node at scale, those initial costs are incredibly high, which dilutes the overall product margin. So it's a double-edged sword. You take some short-term pain for an explosion in long-term competitiveness. But here is the super exciting part. Management actually confirmed that 18A yields are improving significantly faster than they originally planned. By the end of this year, as the manufacturing process matures, those Panther Lake margins are going to improve dramatically.
Which perfectly sets up Chapter 4, Intel's foundry long-term potential. How exactly does that short-term manufacturing pain translate into long-term dominance? Well, if we track their roadmap, the direction is crystal clear. Because they are hitting their 18A yield targets early by mid-2026, they are essentially paving a superhighway straight to their next-generation 14A node. In fact, 14A is already showing better performance in yield at this stage of its life cycle than 18A did. This leads right into the second half of 2026, where they expect major design commitments from external clients, setting the stage for massive external volume production by 2027. They're proving they can't just make chips for themselves, they're getting ready to be the foundry for the world.
And remember, their foundry business is way more than just baking silicon wafers. Their custom ASIC chip business and advanced packaging services, they have absolutely exploded past initial estimates. These are rapidly becoming incredibly high-profit segments, already generating over $1 billion in annual revenue. The market demand for advanced packaging specifically has skyrocketed from initial projections of a few $100 million to a multi-billion-dollar backlog. It's wild.
Finally, let's bring it all home with Chapter 5. Beating AMD and ARM. So how is Intel leveraging all this returning manufacturing muscle and AI demand to execute their ultimate strategy of crushing AMD and ARM? Well, to claw back data center market share from AMD, Intel is holding nothing back. They are executing a rapid-fire server CPU roadmap. They are moving relentlessly from Granite Rapids straight into Diamond Rapids and then on to Coral Rapids. With every single step, they're aggressively increasing core counts and structural value. They aren't just trying to raise prices, they are driving growth through massive volume and vastly superior architecture.
And when it comes to the long-term structural threat from ARM processors, Intel's ultimate competitive moat is their XPU strategy, combined with full vertical integration. Let's be real here. Absolutely nobody else in the market can seamlessly combine x86 CPUs, discrete GPUs, custom ASIC design, advanced packaging, and an in-house foundry service all under one roof. This kind of unmatched heterogeneous computing power is exactly what giant tech clients are going to need to handle highly complex, diverse AI workloads in the future.
All right, to wrap up this explainer, I really want to hear from you down in the comments. First, do you actually believe this industry shift toward AI inference and the orchestration layer is enough for Intel to beat AMD and reclaim their market share? And second, which US tech company's earnings should we decode next week? Drop your thoughts below. And hey, if this explainer saved you a couple of hours of pouring through financial jargon, hit that like button for me. I'll see you in the next explainer.